Monetary policy, central bank interest rate tools. When inflation starts creeping up, the first line of defense is usually the central bank raising interest rates. Here's how it works. When a central bank like the Federal Reserve or the Bank of England raises its policy rate, borrowing money becomes more expensive for everyone. If you're thinking about taking out a loan for a car or a house, higher rates mean higher monthly payments. For businesses, it means more expensive credit for expansion. This increased cost of borrowing naturally dampens demand. People spend less, companies invest less, and that reduction in economic activity puts downward pressure on prices. After the COVID-19 pandemic and the energy price surge in 2022, we saw this play out in real time. The Bank of England hiked its rate from just 0.1% all the way to 5.25% by mid-2023, as inflation hit 11.1%. The US Federal Reserve did something similar, pushing rates to 5.25 to 5.50%. History backs this up. In the early 1980s, Fed Chair Paul Volcker raised rates dramatically to crush double-digit inflation, and it worked, though it also triggered a recession. Research looking at 100 inflation episodes since the 1970s found that countries keeping tight monetary policy for several years were more successful at getting inflation back under control. But there's a trade-off. Higher rates can tip economies into recession and spike unemployment, and if a central bank loosens policy too soon, inflation can roar back. Unconventional monetary policy, quantitative easing and tightening. When interest rates get close to zero, central banks run out of room to cut further. That's when they turn to unconventional tools like quantitative easing, or QE. This involves massive purchases of government or corporate bonds to inject liquidity into the system and push down long-term interest rates. The Bank of England bought about £895 billion of bonds after 2009 to stimulate the economy and lift inflation toward its 2% target. By buying these bonds, the central bank lowers borrowing costs across the board and raises asset prices, which encourages spending. But when inflation gets too high, central banks can reverse course with quantitative tightening, or QT. This means selling off those bond holdings or letting them mature without replacement, which tightens financial conditions. Between 2022 and 2025, the Bank of England began shrinking its balance sheet, while also raising rates to fight inflation. The advantage here is that these tools can work when traditional rate policy hits its limits. QE helped prevent deflation after the 2008 financial crisis across major economies like the US, Europe, and Japan. The downside is that too much QE, when inflation is already high, can make things worse by flooding the economy with money. It can also fuel asset bubbles and worsen wealth inequality, and reversing it with QT can tighten conditions too abruptly. Fiscal policy, government budgetary measures. Governments can also fight inflation through their budgets by raising taxes or cutting spending. This is called contractionary fiscal policy, and the idea is to remove demand from the economy. If the government slashes spending or raises taxes, there's less money circulating, which means less demand for goods and services, and that should cool inflation. The IMF notes that during high inflation periods, reducing government spending or raising taxes is a direct way to reduce aggregate demand. The problem is that this approach is politically toxic. Nobody likes tax hikes or spending cuts, especially during tough economic times. It can provoke strikes, social unrest, and political backlash. Historically, major economies have relied more on monetary policy to control inflation precisely because fiscal tightening is so unpopular and difficult to implement. In the 1970s, Britain, for example, tax hikes sometimes led to strikes and wage demands that actually fed into a wage price spiral, undoing the intended effect. Fiscal policy can also deepen recessions and cause unemployment, making it a blunt and painful instrument. While it can directly reduce demand without touching interest rates and improve fiscal sustainability, the political and social costs often make it a last resort. Price and wage controls. Some governments have tried to simply freeze prices and wages by law. The idea is straightforward. If you cap what businesses can charge and what workers can earn, you stop inflation in its tracks. The US did this under President Nixon from 1971 to 1974, imposing broad wage and price controls to fight inflation after leaving the gold standard. During World War II, many countries used price controls and rationing to manage inflation during wartime shortages. The problem is that price controls mess with market signals. When you set a price ceiling below what the market would naturally settle on, suppliers cut back production because it's not profitable. This creates shortages. People can't find the goods they need at the controlled price, so black markets emerge. The St. Louis Fed has noted that these broad controls eventually failed in the 1970s and are generally costly and ineffective for fighting inflation. They can provide temporary relief and make for politically visible action, but they distort supply and demand, create inefficiencies, and fuel underground markets. Once the controls are lifted, all that pent-up inflation pressure bursts forth. The US wage and price freeze led to mixed outcomes and was eventually abandoned. Exchange rate anchoring. Some countries use their currency as an inflation anchor by pegging it to a stable foreign currency, usually the US dollar. By fixing the exchange rate, a country essentially imports the monetary discipline of the anchor currency. Argentina did this in 1991 with its convertibility plan, fixing the peso to the dollar. Inflation, which had averaged around 600% annually in the 1980s, fell to roughly 4.6% between 1992 and 1998. The peg forces a country to maintain sound fiscal and monetary policies because it needs foreign reserves to defend the fixed rate. Research shows that pegged exchange rate regimes generally have lower inflation and less volatility than floating currencies. It's particularly useful for countries with a history of monetary chaos. Some emerging markets have adopted currency boards or even full dollarization to escape hyperinflation. But there's a huge downside. You lose independent monetary policy. You can't adjust interest rates to your own economic conditions because you're tied to the anchor currency. You're also vulnerable to currency crises if your reserves run out. Argentina's peg eventually collapsed in 2001, and high inflation returned. Pegs require strict fiscal discipline, and without it, they fail catastrophically. Inflation targeting. Many modern central banks now adopt an explicit inflation target, usually around 2%, as their guiding framework. The central bank uses all its monetary tools to keep inflation within that range. New Zealand pioneered this approach in 1990, and others like Canada, the UK, and eventually the US followed. The Federal Reserve only formally adopted a 2% target in 2012. The power of this strategy is in anchoring expectations. If people and businesses believe the central bank will keep inflation at 2%, they'll make pricing and wage decisions accordingly, which makes the target self-fulfilling. This provides clarity and credibility. Over decades, this regime has correlated with low, stable inflation in advanced economies. When a central bank builds trust over time, it becomes easier to defeat inflation because expectations remain anchored. But there are downsides. Strict adherence to a numerical target can limit flexibility. The central bank might overlook output gaps or financial risks in pursuit of the number. If the bank repeatedly misses its target, especially publicly, it can unanchor expectations and lose credibility. Some critics also argue that focusing too rigidly on an inflation number can neglect other important objectives like employment or financial stability. Supply-side policies Instead of crushing demand, governments can fight inflation by increasing supply or removing bottlenecks. This includes boosting production of key commodities, expanding labour supply, or reducing trade barriers. In response to the 2022 energy price spikes, the US released oil from its Strategic Petroleum Reserve. Analysis by the US Treasury estimated this cut gasoline prices by about 17 to 42 cents per gallon and helped mitigate the impact of rising gas prices on overall inflation. Other supply measures include encouraging renewable energy to reduce fuel costs, easing regulations to stimulate housing construction, or reducing import tariffs on food and goods. The advantage here is that you're directly addressing cost-push factors of inflation, like a sudden commodity shortage. You can raise long-run productive capacity without harming demand and employment the way rapid rate hikes do. But many supply fixes take time. Building factories, training workers, or developing new energy sources doesn't happen overnight, so the short-run impact can be limited. Government interventions like subsidies or reserve releases can be costly and temporary. If not well targeted, they can distort markets. Poorly designed price subsidies, for instance, can create fiscal burdens without actually solving the underlying shortage. Managing expectations and communication. A critical but often overlooked strategy is anchoring public inflation expectations through credible commitment and clear communication. If people and businesses expect low inflation, they'll behave in ways that make it come true. Workers won't demand huge wage increases, and businesses won't aggressively raise prices. Central banks emphasize this constantly. Former Fed Chair Ben Bernanke noted that well-anchored expectations, where everyone expects 2% inflation, mean that a temporary price spike won't spiral into lasting wage price increases. Central banks use forward guidance and transparency, publishing projections and detailed inflation reports to convince markets they'll act against inflation. Countries with a track record of price stability find it much easier to defeat inflation because expectations remain anchored. But this only works if the central bank is credible. If credibility is lost, communication alone fails. It must be backed by actual policy action. Miscommunication or inconsistent signals can confuse markets and worsen uncertainty. The advantage is enormous when it works. You can reduce inflation with less costly policy changes, but it requires years of building trust. And once lost, that trust is hard to regain.